We now come to the final part of our discussion on FRA Unit 1, and in this we are going to kind of talk about the cash flow and quickly revise and summarize all our broad discussions on accounting that we have had so far, right? So let's begin with the cash flow statement and understand what do we mean by the cash flow statement. Recall that we had said that the balance sheet on a particular date being B1 and on another date being B2, let's say these are a year apart, right? Financial year 2016 ending and financial year 2017 ending. All business transactions, which is what did you produce, what did you sell, is accounted for in the profit and loss statement, right? That, however, does not take into consideration whether or not the money has come in or whether or not the cash has gone out, right? If I sell something and my customer has not yet paid me, the P&L account will not look at that at all. The P&L account will just record the sales as soon as the ownership is transferred. Whether cash has come in or not is going to get recorded in what is called as the cash transaction, right? And cash transactions will be recorded in the cash flow statement. Once again, like the profit and loss account, the cash flow statement is a periodic statement. It is not at a particular point of time. And so from point B1 to point B2, the company does some business activities. All those get recorded in the P&L statement or profit and loss account. And the company does receive cash or gives cash. All those cash statements are recorded in the cash flow statement, right? So effectively, that's the objective of broad cash flow statement, which is it tells you when is money coming in and when is money due to go out. It tells you about the position of cash inflow and outflow for the company, right? It is possible, and let's take a very simple example and understand it. It is possible that I make a digital pen, let's say, the one with which I'm writing. Let's say this digital pen is worth rupees 100, right? I sell it, but do not receive cash, right? So it will appear as sales, but it will also appear as accounts receivable, correct? Because I'm supposed to receive this money. I've not yet received it. It becomes a current asset if you recall the statements on the balance sheets accounts, right? Now, I might be profitable on this, which means my cost might be 70 and I made a sale of 100. So I might be profitable with this 30. But the reality is, if I have not received the cash, when I receive it, I will be profitable. But if I require the money today, I don't have that. So that's why cash flow statements assume a lot of importance in terms of understanding the cash position of the company at any given point of time. And on a day-to-day running activity of a business, cash flow statements therefore become an important ingredient to the overall understanding of financial statements that we are looking at, right? More on cash flow statements as we go along, but if we now go back and recall our discussion on the three kinds of activities that come up, we also typically divide the cash flow into those three kinds of activities. Remember the three activities? We have operating activities, we have investing activities, and we have financing activities. So when we divide the cash flow into these three segments, based on how much money is coming in and how much money is going out on either of these activities, we create the cash flow statement based on that, right? And that means that cash flow from operating activities would mean any operations of the firm. Remember, we said revenues and costs. Anything that are coming on this front, cash going in, cash going out, because of that is going to come in on cash flow from operating activities. Since revenues and costs are largely going to come from the profit and loss statement, usually you can relate this to the activities from the P&L statement, right? Then you could buy slash sell assets. That's all going to be cash from investing activities. Any cash flow due to investment activities such as buying and selling assets, cash inflow, cash outflow. Usually you can relate this to activities from the asset side of the balance sheet. In the balance sheet, on the asset side, if you buy a fixed asset or a factory versus if you sell a fixed asset or a factory, that's going to form the crux of your investing activities. And then finally, raise or repay money is what you are going to look at. Any cash flows due to financing activities such as raising and deploying money are going to go under cash flow from financing activities, usually because raising money and repaying money happens from guys who are the liabilities for us or who are the sources of funds for us who are giving us money. This will relate to the liability side of the balance sheet, right? So P&L statement is here, balance sheet asset side is here, balance sheet liability side is here, largely and loosely speaking. There are nuances in this which get captured at separate points of time. When we look at cash flow statements in more detail, we will understand this entire context of how the cash flows play out, right? That's our cash flow statement. That's broadly how cash flow statements would look like. Let's now broadly summarize what we have done so far and also kind of try and discuss what are the key principles and assumptions that go into the accounting activities, right? So there are going to be some accounting principles that we have to work with, right? What are these accounting principles? There is something called as a cost concept. All items are recorded at their cost value in the balance sheet and all. When you buy a flat or buy a land piece or buy a factory, the cost of that comes up. Now next year the price of that might change in the market. You don't revise it very frequently, right? So all items are recorded at their cost value. Consistency and comparability. Financial statements are to be prepared consistently without deviating from the accounting principles so that details are rendered comparable. Now that's important also because you are typically going to compare it across firms and across the timeline of the same firm. So it's important that it is consistently using those principles year after year. Conservatism. The books of accounts should not overstate the financial positions. You have to be conservative. Profits are not to be recognized unless they are realized, and losses should be recognized as soon as they are known, right? So be conservative when you are creating accounts is what accounting principle says. Matching principle. Identification of related income and expenses pertaining to an accounting activity, accounting period or accounting major head. This needs to happen. So you have to match the incomes and expenses as such that come in. Profit realization, as you said earlier, profit should not be recognized until they are realized. Materiality. The real important items for the purpose of accounting to be recognized are amounts that matter for the organization, right? Non-material is basically small or minor amounts. You can ignore the non-material part of the accounting statements. That's not really very necessary, right? These are the broad principles which will apply when you are using the accounting activities. There are certain assumptions also that come in when you are kind of building the accounting system for a firm. The first one, we have discussed it earlier, is the accounting entity. The accountants treat a business as an accounting entity, and this is separate from its owners and other firms. So owner is not the same as accounting entity. Accounting entity is the business for which you are basically creating the accounts. That is different when compared to the owner. The next principle that comes in is something called as going concern. All the accounting reports that will result in bookkeeping, it has to basically use, and the values that are taken in bookkeeping, they should assume that the business is going to continue till infinity. It should not take for granted that the business will be closed or wound down. The going concern principle, however, should not be confused with conservatism. So in general, if the company is doing fine, you would expect it to go till infinity. But if you believe that the company may have reasonable assumptions of closing down, then you have to apply the conservative principle there, right? Accounting period. We have said that usually it's 1 year, and we are usually looking at somewhere around April to March as the accounting period. The period for which the accounting is maintained is is in one stretch, the period from date of drawing the final accounts to the next date of drawing the final accounts, usually annual, right? And usually the balance sheet date. Money measurement. Money is the only common denominator for all the businesses. Accounting record all business transactions in the terms of money. So money is the currency of our discussion everywhere. When we are looking at accounting assumptions, when looking at accounting concepts, we're going to deal only with respect to measuring what is monetarily be establishable. What has a market value is what is going to come into this, right? That's the money measurement. Let's summarize our final discussion in terms of what is going to be the accounting equation. It basically shows the relationship between the economic resources of a business and the claims against those resources. What are the economic resources? These are the application of funds. The claims are going to come from the source of funds. Remember, someone has given you money, they will claim that back. You will use that money, application of those funds, and take some economic resources. So obviously, economic resources will be your assets. The claims would be either owner's equity, which is in a sense a liability, and all external liabilities. So I say owner's equity and external liabilities, which basically means that the assets that a business have should be equal to owner's equity plus external liabilities. Together, most balance sheets combine the two and talk about them as total liabilities that a firm has, because owner is a separate entity. You are still liable to repay the money to the owner, correct? So that's the concept of the accounting equation. Always remember, this will always remain matched. So any transaction that the company does is either going to affect both sides of this equation or is going to rearrange the items on one side of this equation, right? But at every given point of time, this equation will hold true. We're going to take a few exercises in subsequent sessions and understand those exercises when we go about doing this. But it is important to remember that at any given point of time, this equality will stay established, right? So any transaction that the company does, for example, the company takes another 10,000 rupees of loan, liabilities will go up by 10,000, and on the asset side, the cash account will go up by 10,000. Now the company might choose this 10,000 to buy a fixed asset. So fixed asset will go up by 10,000, cash will go down by 10,000, but the equation will remain the same, established, right? That's the end of this particular section. That also broadly brings us to an end of this unit. We will look at a small example of how transactions go and impact financial statements. But broadly, let's end with this set of questions. Explain the usage of cash flow statements in the context of financial statements that a company builds. What is the going concern assumption? And what is the accounting equation? Thank you.